For years, we've been conditioned to believe that building wealth is a game of chance. We wait for the next big investment opportunity, hoping it'll be the one that finally sets us on the path to financial freedom. But what if I told you that's not how it works? Research by Fidelity Investments shows that only 1 in 5 Americans have enough savings to cover a $1,000 emergency expense, yet we continue to throw our hard-earned money at get-rich-quick schemes and investments with lofty returns. The reality is, building wealth requires discipline, patience, and a deep understanding of how money works. It's not about getting lucky or stumbling upon the next big thing, it's about making informed decisions that can have a compounding effect over time. Yet, millions of people are making the same costly mistake when trying to build wealth. According to a study by Northwestern Mutual, 62% of Americans believe they need to earn more money to achieve their financial goals. However, what if I told you that earning more isn't always the answer? The truth is, many people who make significant salary increases end up blowing it all on lifestyle upgrades and consumer debt. They're not investing in assets that truly appreciate over time. In fact, a study by Charles Schwab found that 75% of Americans are confident they can achieve their financial goals if they simply earn more money. But what about the other 25% who don't? Are they doomed to remain financially stuck forever? Not necessarily. The key lies in understanding and leveraging the power of compound interest, something Warren Buffett has mastered throughout his career. Now, I know what you're thinking, what does any of this have to do with me and my financial situation? But bear with me for just a moment longer. Because once we understand the principles behind building wealth, we can start making informed decisions that will get us on the right track. And I'm here to tell you, it starts with avoiding a $10,000 mistake most people make when trying to build wealth. Welcome to the harsh reality of building wealth in today's economy. For far too long, people have been chasing the myth that financial success is a matter of luck and chance. They hold on to the idea that they'll strike it big with a small windfall or inheritance, only to find themselves back at square one when it all comes crashing down. But the truth is, building wealth takes work, dedication, and a solid understanding of how the game is played. And yet, millions of people continue to make the same mistake over and over again, investing in assets that may sound exciting but have no real potential for long-term growth. Take real estate investing, for example. While it can be a lucrative venture for some, many investors get caught up in the hype and pour their money into overpriced properties with thin margins for profit. According to data from Zillow, the median home value in the United States is now over $270,000, a staggering 50% increase since just 2012. Meanwhile, others are getting sucked into the vortex of cryptocurrency investing, chasing the latest hot coin or token without doing their due diligence on its underlying fundamentals. As we've seen time and time again, these assets can be incredibly volatile, with prices dropping by as much as 90% in a matter of months. And then there's the stock market, where even experienced investors can get caught up in the noise of daily fluctuations and make impulsive decisions based on emotions rather than sound judgment. The S&P 500 index, for instance, has returned an average annual gain of just 7% over the past 20 years, a far cry from the 10 to 15% returns that many investors are shooting for. As we'll explore in this video, there's one crucial mistake that most people make when building wealth, and it's not what you'd expect. It's not about investing too little or saving too much, it's actually about making a single decision that sets off a chain reaction of costly consequences down the line. As we delve deeper into the world of wealth building, it's essential to recognize that most people make a critical mistake that ultimately derails their progress. This error is not just about overspending or failing to save, but rather it's a fundamental flaw in their financial strategy. According to a study by Charles Schwab, 62% of high net worth individuals attribute their success to disciplined investing and long-term planning. However, the average person is more likely to follow the crowd and make impulsive decisions based on short-term gains. One of the most significant mistakes people make is focusing on getting rich quick rather than building wealth over time. This mentality can lead to poor investment choices, such as putting all their eggs in one basket or chasing after get-rich-quick schemes. Consider the story of Robert Kiyosaki, author of Rich Dad Poor Dad. He advocates for financial education and building multiple streams of income to achieve wealth. However, many people overlook this crucial aspect and instead rely on a single source of income, leaving them vulnerable to market fluctuations. The numbers don't lie. Over 40% of Americans report living paycheck to paycheck, with no savings or emergency fund in place. Meanwhile, those who prioritize long-term investing tend to be more successful, with the top 1% of earners holding approximately $26 trillion in assets. By understanding this critical mistake and taking steps to correct it, individuals can avoid falling into the same trap as millions of others. By adopting a patient and informed approach to wealth building, anyone can achieve financial success and create a more stable future for themselves. Consider the story of Mark Zuckerberg, co-founder of Facebook. His initial public offering, IPO, in 2012 generated a staggering $16 billion. Had you invested just $1,000 into Facebook stock at its IPO price, your return on investment would be approximately 1,600%. Now, if I were to ask you to replicate this feat by investing in the next hot startup or penny stock, how many of you would say it's possible? Probably most. But here's a crucial distinction. Mark Zuckerberg didn't stumble upon Facebook's success overnight. He and his co-founders had been working on the platform for years prior. They also made strategic decisions about where to invest their resources, when to go public, and how to manage risks. Now, fast forward to today, what if you applied a similar mindset to your own financial decisions? Let's examine some data from a 2020 study by Fidelity Investments, which found that only 3 in 10 investors achieved above-average returns over a 5-year period. However, these high-achieving investors were not necessarily the ones who took on excessive risk or attempted to time the market with speculative investments. Instead, they made informed decisions about asset allocation, tax efficiency, and compound interest. To illustrate this concept further, consider the case of Warren Buffett, one of the most successful investors in history. He has stated publicly that he wouldn't invest more than 25% of his portfolio in any single stock or sector. This approach has served him well over decades, allowing him to ride out market fluctuations while still capturing significant gains. So what can we learn from these examples? It's not about getting lucky and finding the next big winner. It's about making thoughtful decisions that align with your long-term financial goals. It's at this point that most people hit a major roadblock in their wealth-building journey. They've invested time and effort into understanding the principles of personal finance, but somehow, they still manage to sabotage their own progress. I'm about to reveal what I like to call the $10,000 mistake, a costly error that's been perpetuated by millions of individuals worldwide. To make it clear, this isn't just some hypothetical scenario. We're talking real people with real financial goals and aspirations. According to a study conducted by the Financial Planning Association, nearly 60% of adults in the U.S. admit to making poor investment decisions at least once in their lifetime. The consequences can be staggering. I've seen it firsthand. Let me give you an example. Meet John, a 35-year-old software engineer who's been diligent about saving and investing for retirement. He's maxing out his employer-matched 401k contributions, and he's got a solid emergency fund in place. However, despite having a decent income and being debt-free, John still finds himself struggling to make progress on his long-term goals. It turns out that John has been following the advice of a well-meaning friend who recommended investing in a trendy cryptocurrency startup. With an initial investment of $5,000, John was promised a potential return of 20% or more per annum. Sounds too good to be true. Unfortunately for John, and countless others, it was exactly that, a classic example of the $10,000 mistake. As we've explored in this video, making small, consistent changes to your financial habits can have a profound impact on your wealth-building journey.